This week, China has moved to support its exporters ahead of Donald Trump's anticipated tariff hikes. And its drive for self-sufficiency is accelerating. Is Beijing better prepared for another trade row with the US this time around?
China has just implemented a shocking trade policy by completely banning all U.S. imports, which causes major economic damage to American organizations. China's sudden trade ban caused seismic effects throughout markets, leading to disrupted supply networks and catastrophic impacts on thousands of domestic businesses operating in America. China consumes multiple vital American export products, which include agricultural products as well as technology components and energy resources. Thus, the sudden trade embargo set off an immediate economic disturbance. The outcomes from this decision include market stock declines coupled with increasing workforce insecurity and broadened doubt regarding forthcoming U.S. trade methods. How will the U.S. government respond to this unprecedented trade ban? Could this lead to a full-scale trade war, or will diplomatic negotiations ease the economic strain? What strategies should American businesses adopt to mitigate the impact of China's sudden embargo? Stay tuned to find out.
Since Donald Trump's re-election as U.S. president, the Chinese leader has been shoring up support at global events. Trump's return to the White House has stirred fears that tensions between the world's two largest economies could worsen.
The trade declaration released at this point emerged when trade conflicts between the United States and China had reached their peak within several years. The United States has observed China develop into its essential international export destination during the past 20 years. Current geopolitical conflicts, along with protectionist trade approaches, have caused U.S.-China relations to reach their worst state in history. This economic measure from Beijing reflects both a financial retaliatory stance and a political signal to the world. Multiple experts assess the forthcoming U.S. reaction as they analyze the economic effects on international markets. The U.S.-China trade rift, how we got here.
Republican pitch. Remember, for at least a century, the Republican Party presents itself in this country as the party against taxes, the party for small government, all of that.
The complete suspension of U.S. imports by China requires an understanding of the historical cooperation and conflicts in U.S.-China trading relations. China has evolved into the United States' major trading partner through the years, thus achieving dramatic growth in its annual trade volumes. The historical partnership between China and the United States displayed equal amounts of helpful cooperation while undergoing occasional economic progress setbacks and political disagreement conflicts. When China joined the World Trade Organization in 2001, the two nations experienced an enormous increase in their trade activity. Economic integration delivered benefits to consumers and companies from both countries, yet Washington officials maintained doubts about Beijing's leadership approach to development. The enduring concerns between the countries have affected trade policies, despite creating complex economic dynamics.
Also filed a lawsuit with the World Trade Organization. But wait, what exactly are tariffs?
Tariffs are essentially tax on the imports from specific countries, potentially on specific goods, or blank tariffs on all the imports from certain countries.
Think of it like this.
The Trump administration intensified diplomatic tensions through major trade limitations against Chinese exports while pursuing solutions for trade inequities and intellectual property issues. China declared its own trade retaliation measures, which triggered a trade conflict that negatively affected multiple sectors. The Biden presidency continued existing trade limitations while creating more restrictions that showed its commitment to addressing China's economic policies.
An hour and a half ago, the US went ahead with its promise of 10% tariffs on all Chinese goods headed to the US. China quickly responded and announced it's to do the same in a tit-for-tat spat that could impact the global economy.
President Trump declared a new 10% Chinese import tariff because China has failed to clamp down on the fentanyl supply to the United States, which China considers blackmail. The Chinese government now plans retaliatory actions based on trade taxes and other restrictions that specifically target American food products and agricultural exports. The latest developments demonstrate how easily the trade connection breaks and strengthens the likelihood of major economic warfare.
President Trump announced that he would be implementing stiff tariffs on America's top 3 trading partners. A 25% tariff on imports from Canada and Mexico, and an additional 10%.
The intricate and controversial nature of U.S.-China trade relations has resulted in the present economic difficulties that emerged after China cut all U.S. imports. What long-term consequences do you think this trade standoff will have on businesses and consumers worldwide? Shockwaves. Across the U.S. economy. The U.S. economy now experiences substantial economic disruptions following the end of exports to China. The manufacturing sector, based on exports to China, operates at a significant revenue loss point. U.S. manufacturers shipped $90 billion worth of products to China every year, as per information from the U.S. Chamber of Commerce. The abrupt revenue loss from Chinese exports requires companies to evaluate their operations while making workforce reductions and operation cuts. The agricultural industry, especially the soybean plus corn production, faces survival challenges and battles to discover new trading destinations for their crop products. The American Soybean Association shows that Chinese customers purchased 30% of American soybean exports, which made them the key foreign market for these products. The disappearance of this market creates a situation where farmers confront excessive farm products, decreased farm values, and accumulating financial obligations. The long-term existence of American farming is uncertain despite short-term support from government subsidies. What alternative markets or strategies could help U.S. manufacturers and farmers recover from the loss of Chinese exports? Let us know about your view in the comments below.
We've kept you updated on a lot of corn buys from Mexico, but where's China? Chinese soybean imports from the U.S. have surged, but Brazil does remain the top supplier. It's reported that of China's 11.37 million metric tons of soybean imports in September, more than half of that, 8.45 million metric tons, came from Brazil, while 1.71 million metric tons came from the U.S. That's a 13-fold surge from last year. For the January to September period, soybean imports from Brazil rose 13%, while arrivals from the U.S. fell 15%.
The drop in industry revenue will cause unemployment rates to increase throughout various sectors. The Midwestern agricultural export regions lead the way in factory shutdowns and worker dismissals, as well as wage reductions. U.S. jobs totaling more than 1.3 million positions rely on trade operations with China, according to statistics from the Bureau of Labor Statistics. Small companies that conduct international business operations face severe pressure since declining demand pushes them toward permanent closure. The shortage of Chinese-made products has forced retailers to raise their prices, which decreases consumer purchasing ability. The financial market sector underwent significant downturns after the announcement. Stock market indices experienced a severe decline after the news broke out due to investors fearing an economic slowdown. Stock market indicators. Dow Jones Industrial Average and S&P 500 and NASDAQ plunged more than 800 points instantly after the disclosure. Generous Chinese market exposure affects technology-powered companies such as Apple, along with industrial manufacturing stalwarts Apple, Tesla, and Boeing through massive stock market valuation losses. The current market uncertainty has led investors to shift their investments towards safe assets, such as bonds and gold, as they try to protect their portfolios.
Retaliated by announcing 15% tariffs on chicken, wheat, corn, and cotton imports from the United States. They also announced a 10% tariff on soybeans, pork, beef, and other various goods.
The negative economic implications in the energy sector match those affecting other business sectors. The Chinese market plays a crucial role as a U.S. oil and natural gas purchaser that faces the risk of unprecedented price drops due to the abrupt trade halt, creating an excess supply. The Energy Information Administration, EIA, reveals that American enterprises exported more than $8 billion in crude oil and LNG to China yearly. American energy organizations currently navigate volatile global markets with reduced income streams, along with potential employment reductions confronting them while infrastructure development funding decreases. The energy sector faces potential destabilization because of this current downturn that sustains the entire economy.
China has imposed retaliatory tariffs on U.S. coal, liquefied natural gas, LNG, and crude oil after Donald Trump introduced new duties on Chinese goods, escalating fears of a broader trade war. Beijing's move, which includes a 15% tariff on U.S. coal and LNG and a 10% duty on crude oil and certain vehicles, comes as Trump seeks to pressure China over trade imbalances and fentanyl exports. Economists warn of wider economic repercussions, though Australian fossil fuel producers may see short-term gains.
The transportation sector, along with the logistics operations, faces adverse effects from dwindling international trade volumes. U.S.-China trade success sustained many shipping companies, along with freight operators and logistics firms, but their revenue has fallen, which created financial hardship for their employees. The economic downturn becomes more severe because of the equalizing impacts on ports, as well as trucking companies and rail networks. The American Association of Port Authorities reports an immediate impact on major ports through financial losses because 20% of their U.S. port activities involve China-related trade operations. According to economic experts, a market-wide economic recession may result if we cannot discover quick solutions to the current economic downfall. United States economic stagnation might become prolonged due to failed agreements with China or the absence of new trade partnerships, which would force companies to cut operations and create economic uncertainty through rising costs for consumers. How can the United States mitigate the economic downturn in the transportation and logistics sector while navigating challenges in trade agreements with China? Global supply chain disruptions. China's import ban spreads its impact through worldwide supply chains, thus causing global countries to experience operation difficulties. Multiple American manufacturing operations that acquire their raw materials from China currently experience serious shortages because of this unexpected disruption across multiple production fields, such as technology, pharmaceuticals, and autos. Production expenses have risen because of the shortages and will probably result in elevated prices that consumers will need to pay for daily necessities. The technology sector in particular is feeling the heat. Many U.S. companies rely on Chinese suppliers for key components used in smartphones, semiconductors, and other electronic devices. With supply chains disrupted, these companies are now forced to explore alternative sourcing options, which may not be as cost-effective or efficient. This shift is likely to drive up consumer prices and slow down technological advancements in the short term. The consequences of this trade halt are also being felt in the consumer goods sector. As supplies dwindle and production costs rise, everyday items ranging from electronics to household appliances are becoming more expensive. This inflationary pressure adds to the already rising cost of living, further straining the average American household's budget. Government response and policy measures. In response to the crisis, the U.S. government has moved swiftly to implement emergency measures aimed at stabilizing the economy and mitigating the worst impacts of China's import ban. Recognizing the severity of the situation, policymakers have rolled out a multi-pronged strategy encompassing economic relief packages, trade realignment, and domestic industrial reinforcement.
China has been another blow. Historically a major export, scrap copper sales have plummeted, leaving American recyclers with mounting inventories and potential job losses.
Economic stimulus and support for affected industries. A substantial economic stimulus package is being introduced to support struggling industries, particularly those most affected by the trade disruption. The U.S. Department of Agriculture, USDA, has announced direct financial relief for farmers facing revenue losses, ensuring that soybean, corn, and pork producers can remain operational despite losing their biggest export market. In addition, the Department of Commerce is providing low-interest loans and grants to small and mid-sized manufacturing businesses suffering from declining Chinese demand. To counteract the rising unemployment rates, the federal government is expanding unemployment benefits, providing direct payments to affected workers, and launching workforce retraining programs. The Biden administration has also initiated discussions on a possible expansion of the Trade Adjustment Assistance TAA program, which provides financial aid and job training for workers displaced by trade disruptions, trade negotiations, and diplomatic efforts. In an effort to de-escalate tensions, U.S. trade representatives have intensified diplomatic negotiations with Beijing, seeking a potential resolution that could restore some level of trade stability. These negotiations involve high-level talks between U.S. Treasury officials, the Office of the U.S. Trade Representative, USTR, and their Chinese counterparts. However, given the geopolitical climate and ongoing disputes over intellectual property, technology restrictions, and national security concerns, experts warn that these negotiations may take months or even years before yielding a meaningful outcome. While diplomatic discussions continue, the White House has been actively engaging with the World Trade Organization, or WTO, and key allies in Europe and Asia to challenge China's trade policies and encourage multilateral pressure on Beijing. Some policymakers are also pushing for retaliatory tariffs or further trade restrictions against Chinese imports, though economic analysts caution that such measures could escalate tensions and exacerbate the economic downturn. Diversification of trade partnerships. To reduce reliance on the Chinese market, U.S. policymakers are aggressively pursuing trade agreements with other nations. The Indo-Pacific Economic Framework, IPEF, has been revitalized, with stronger ties being forged with nations like India, Vietnam, and Indonesia. Additionally, renewed discussions with the European Union, Canada, and Mexico are focused on expanding export opportunities for American businesses.
And increased resources to stop the flow of fentanyl.
The United States-Mexico-Canada Agreement, USMCA, is being leveraged to bolster regional trade and create alternative supply chains that are less dependent on China. Similarly, the Biden administration is exploring stronger engagement with African and Latin American economies, particularly Brazil and Argentina, as potential new markets for agricultural exports. Domestic industrial policy and supply chain resilience. Beyond external trade strategies, the crisis has prompted a renewed focus on domestic manufacturing and industrial self-sufficiency. The CHIPS and Science Act, which aims to boost semiconductor manufacturing in the U.S., is being expanded to accelerate investment in high-tech production and reduce reliance on China for critical electronic components. Additionally, the Infrastructure Investment and Jobs Act is being used as a platform to enhance domestic logistics and supply chain networks, ensuring that American businesses can source raw materials and finished goods locally instead of depending on volatile international markets. Congress is also reviewing a Made in America initiative that includes tax incentives for companies that shift manufacturing operations back to the U.S. This move aligns with the broader reshoring trend, which gained momentum during the pandemic and has been further reinforced by China's recent economic maneuvers. While the immediate response focuses on damage control, long-term policy adjustments are already in motion. Lawmakers are considering a fundamental shift in U.S. economic strategy, one that prioritizes diversified trade, strengthened alliances, and technological innovation over reliance on any single foreign market. Some experts suggest that the crisis could serve as a catalyst for the U.S. to rethink its economic dependencies and accelerate a transition toward a more self-reliant industrial ecosystem. While the road to recovery remains uncertain, the U.S. government's response will determine whether this crisis leads to prolonged economic distress or a strategic realignment that strengthens America's global economic position. Long-term economic consequences. The long-term effects of China's import cessation could reshape the U.S. economy in profound ways. One potential outcome is an industrial shift, with companies opting to relocate manufacturing facilities to countries with more stable trade relationships. While countries like Vietnam, India, and Mexico could become new manufacturing hubs, this transition requires significant capital investment, regulatory adjustments, and workforce training. In the short term, businesses will likely struggle with supply chain disruptions and production delays before any tangible benefits emerge.
He had texted out that the tariffs were coming unless Canada controlled fentanyl and immigrants crossing the northern border into the U.S. I'm not entirely sure how big a problem those two things are, or whether they're more.
Another consequence is an increased focus on domestic innovation. To counteract reliance on foreign markets, the U.S. may prioritize advancements in automation, robotics, and artificial intelligence. This push could lead to the resurgence of certain industries, such as semiconductor manufacturing, which has been heavily dependent on Chinese supply chains. While this shift may create high-tech jobs, it could also accelerate job losses in traditional manufacturing, creating socioeconomic challenges for workers who lack the skills to transition into a tech-driven economy. The global economic landscape is also poised for transformation. With China forging stronger trade ties with alternative partners, new economic alliances may emerge, potentially diminishing U.S. influence in global trade. Nations within the European Union, ASEAN, and the BRICS group may capitalize on the shifting dynamics, forming stronger economic blocs that compete directly with U.S. markets. The long-term challenge for the U.S. will be to adapt to this evolving trade environment while maintaining its economic leadership and industrial competitiveness. The restructuring of trade dynamics could also impact the dollar's dominance in international transactions. As China strengthens trade with non-U.S. partners, there may be a greater push toward alternative currencies, such as the yuan or digital currencies, weakening the global influence of the U.S. dollar. This shift could have long-lasting implications for U.S. financial markets, monetary policy, and global economic stability. The road ahead, challenges and opportunities. The path forward remains uncertain, and much depends on how quickly the U.S. can adapt to these new economic realities. Diplomatic efforts to restore trade relations with China will be crucial in determining the future trajectory of the American economy. However, negotiations may prove difficult, given the deep-seated tensions and competing national interests. Simultaneously, businesses will need to innovate and explore alternative markets to mitigate losses. Strengthening trade partnerships with Europe, Southeast Asia, and Latin America could help offset some of the economic damage. Policymakers are already pushing for increased domestic production and supply chain diversification, aiming to reduce dependency on foreign markets.
Well, these are a couple of things that I'm responsible for as a province. The federal government's leading the charge. The communication has been fabulous with the PM and the government as well. I said, number one, I don't start a tariff war, but we're going to win this tariff war. I've directed the LCBO, we're the largest purchaser of alcohol in the world, to remove every bit of U.S. alcohol off the shelves. I know my good friend, the governor of Kentucky, he's losing his mind right now. I said, you better talk to your president. Mitch McConnell, senior senator from Kentucky, they're losing their mind. We purchase over $1 billion of alcohol, 3,600 products, 35 states. It's going to hit them. We call them the kitchen table issues. Then we're going to cancel Starlinks right away from Elon Musk. Not that $100 million makes a difference for them, but it's principle. I've directed the procurement of over $30 billion of goods, not to go to the U.S., to make sure we buy Ontario first. And if we can't find it in Ontario and we can't build it in Ontario, we go across the country. We have 51 tariff-free agreements with countries around the world. We're going to diversify our trade. If they want to try to annihilate Ontario, I will do everything, including cut off their energy, with a smile on my face. And I'm encouraging every other province to do the same. Quebec, Manitoba, BC, we all have to act in unison. Out east, they rely on our energy. They need to feel the pain. They want to come at us hard, we're going to come back twice as hard.
As tensions continue to unfold, economists and analysts remain divided on the long-term implications. Some argue that this crisis will ultimately drive the U.S. to become more self-reliant, fostering domestic growth, technological advancements, and job creation. Others warn that prolonged trade isolation could lead to economic stagnation, reduced global influence, and a prolonged recession. One thing is certain, the U.S. economy is at a crossroads, and the decisions made in the coming months will determine its future trajectory. Will this crisis be the catalyst for economic resilience and transformation, or will it mark the beginning of a prolonged downturn? Only time will tell. How do you think the U.S. should navigate this economic crisis? Share your thoughts in the comments below. If you found this analysis informative, please like, share, and subscribe for more in-depth coverage of global economic events.